This is Brian Lysing. I'm Life Insurance Sales Director at Financial Brokerage. If you're not familiar with Financial Brokerage, we are a national life insurance, annuity, long-term care, and disability marketing organization based in Omaha, Nebraska. We work with producers like yourself all across the country. And one of the things we like to do is bring some new sales ideas to the table, give you additional reasons to call on your existing clients and reach out to new ones that you would like to have become your clients. And one of the ways I think we can do this very effectively is with linked benefit products. Now, the session is called Linked Benefits 202. I am assuming that you are already familiar with linked benefit products that combine life insurance and long-term care, maybe long-term care and annuities together into one package. We have a separate webinar that goes over the basics and the ins and outs of those products. But I wanted to bring some more advanced concepts to the table because there are a lot of things out there that a person can do with these products I think a lot of people aren't aware of. There are some creative solutions to some problems that I think it's worth getting the information out there. When you come across those situations, you'll know exactly what to do and how you can help your clients. So we're going to cover some advanced concepts dealing with linked benefit products here this morning. And our agenda here really is to help you protect your clients' assets from the greatest threat they face in retirement. And we're going to do that through 5 creative advanced concepts with linked benefit plans, so your clients don't have to worry about the high cost of extended care or wasting their premium dollars. Now, why is this even an issue? Well, long-term care or extended care costs a lot of money. In fact, from the survey Genworth put together back in 2012, it costs about $81,000 a year right now, or at least back in 2012. For skilled nursing care, that's in a 24-hour facility. But what if a person doesn't need to be in a nursing home itself? We're still looking at about $40,000 per year for assisted living and about the same amount for home health care. Now, that assumes only 40 hours a week. That's 8 hours a day. That's your normal work week. That assumes that a family member or somebody else is stepping in the interim. If somebody needs 24-hour care at home, that number is going to be much, much higher. So great question you should be asking of yourself and of all of your clients is, well, how long is their money going to last at that pace? And with the exception of very few people out there, it's not going to last very long. So what do we do about that? Well, insurance is there to help in this situation. Now, in the past, there's really been one way to handle this, and that's with the traditional long-term care insurance policy. It still fits in some situations. LTC policies are great. I own one myself. My wife owns one. But we're seeing some changes in the marketplace out there. Sales have been decreasing. This has been going on for a decade or more. Premiums are increasing on new plans being sold and also on existing plans. The saying is that it's not a matter of if your LTC plan experiences a rate increase, it's a matter of when. And because of all these things, we see a lot of carriers exiting the market. There aren't many carriers that are offering long-term care anymore, especially if you look back 10 or 15 years to what was in the marketplace at that point in time. So what do we do about it? Well, I think the marketplace has come up with the solution, and that's linked benefit products. They combine LTC with a life policy or with an annuity policy, and sales have been going through the roof. I don't have the numbers for 2014 yet, but you can see where we were at back in 2006. Less than $500,000 in sales in linked benefits, and just 6 years later it was up to $2.4 billion, $2.6 billion in 2013. The numbers just go up and up and up. Well, what makes these linked benefit plans so popular? I think it's 2 important guarantees. Every producer I ask this question of who sold linked benefits, they give me one or maybe both of these answers as to why did the client want this? Why did they purchase this over some other type of coverage you may have proposed? And one of the key factors is the fact that the premium will never change. These are either single premium products, they're based on a whole life chassis, or a universal life with a no lapse guarantee provision. They will never be asked to put in more money than what the contract originally called for. The other important guarantee driving the sales is the fact that the benefit is going to be paid out, some sort of benefit. If they need long-term care, they'll get that LTC benefit. If they don't need long-term care, their heirs are going to receive the death benefit. So they have two very important guarantees. Now, that's sort of the basis that gets us started here. So this morning, we're going to go over 5 advanced concepts that deal with these products and help you think of ways to use them in ways that you probably didn't think of before. We're going to go over a way to help cover an uninsurable spouse. We're going to discuss why joint coverage might be a good option. We're going to find a way to include inflation protection on a multi-pay policy. We're going to find a way to use qualified funds and also go over a concept I like to call extreme leverage. You've probably never seen dollars leveraged quite to this extent, and one of our carriers has found a way to do that. So I'll jump right into dealing with an uninsurable spouse. Now, how many people have heard this phrase uttered by clients? You sit in front of a husband and wife, you apply for long-term care, whether it's traditional LTC or a hybrid policy, one of them gets declined. I mean, it's going to happen. And this is a typical response. The person says, well, you know what, if your company isn't going to take my spouse, I don't want a policy from you either. It makes absolutely no sense. There's no logic to this at all. So instead of having one person covered, now they're going to have nobody covered. It just boggles the mind why people would do this. But they're not thinking logically. They're thinking with emotion. So what's the solution to this? Well, one solution, I don't have a slide for it, but would be to use an annuity for that uninsurable spouse. Now, with the annuity-linked benefit plans, you don't get quite as much leverage as you do with the life products, but the underwriting is either much, much less or it's completely non-existent. So that is one option. We talk about that in the other webinar that we do. But I want to talk about maybe a more creative way to handle this. And to do that, we need to use a couple of riders that are only offered by AIG American General, and it's on their Secure Lifetime GUL. Now, the first one is what they call the Accelerated Access Solution rider. It doesn't matter what they call it. This is a chronic illness rider. It's available for LTC expenses. Now, it's not a true LTC rider, difference being your client still has to lose 2 of 6 ADLs or have severe cognitive impairment, but the condition has to be deemed to be permanent. Now, most of the life insurance-based riders are of this variety, the chronic illness type. Now, this pays out an indemnity benefit. That means the money can be used for anything at all. You don't have to prove expenses or be reimbursed. Whatever the client's monthly benefit is, they're going to get a check for that amount. And they also offer an option for the client to have as their benefit not just 2% or 3% of their face amount per month. They can have the full federal per diem limit. This is a number the federal government sets every year, and they say that LTC expenses up to this amount are received tax-free. If you go above that amount, you're going to have to get with the IRS and prove that you had some expenses there. So they'll set that amount at, if the client wants, at the per diem limit. Right now it's $330 a day. It's $9,900 per month. The client can use the money for any reason. The other rider they have available, they call the Lifestyle Income Solution rider. This is very innovative. AIG is the only one that has this to my knowledge. And it says that at age 85, the client can accelerate 10% of their death benefit per year for any reason. So that's our solution. I'm going to help you make sense of this by using an example here. You might be asking, well, how does this help the uninsurable spouse? Well, it's all going to become pretty clear here in a minute. Let's take a couple, and in this case, we have a husband and wife, and the husband was uninsurable. His wife is 60. She's in good health. We're going to get her a $500,000 policy. Costs about $10 grand a year for this, and we're going to put on the per diem chronic illness benefit on this. So right now, she gets up to $9,900 per month, and that per diem limit increases every year. It's been going up about 4% on average every year. So that number will continue to grow over time. Now, this client of ours also has, because it's a $500,000 policy, she has 10% available beginning at age 85. That's $50 grand a year. All she has to do is turn 85 and tell AIG, hey, I want the money. Now, please send me a check, and they'll send her $50 grand a year until she tells them to stop. The first monies that come to her are considered a return premium and are not taxable. After that, the money becomes taxable, but a client is taking this because they need the money. They're probably not going to mind having to pay a little bit of taxes on it because it's money they otherwise wouldn't be able to access without dying first. So how can this be used to pay for the husband's expenses? Here's how. It's all dependent upon the healthy spouse who has this policy. And I only have 2 examples here, but there's actually 3 ways that the husband can access this money. So one, when his wife turns 85, if our husband in this case needs care and has expenses, all his wife has to do is turn on that lifestyle income solution rider. She's going to receive $50,000 a year. They don't care what she does with that money. If she needs that to pay for her husband's LTC expenses, she can use it for that reason. If she wants to take a trip to Jamaica, she could do that too. But that money is there for her to use for whatever she wants. Second way we can access her policy to help pay the husband's expenses, this requires the wife in this case to have a need for long-term care. She's lost 2 of 6 ADLs or has severe cognitive impairment. Now she starts to receive her benefits under this rider. It's $9,900 a month right now. It's going to grow over time. Right now, that comes to $118,000 per year. What if her expenses are $60,000 per year? Guess what? She has a lot of money left over that could be used towards her husband's LTC expenses. Now, the third way we can help out the husband here, unfortunately, his wife would have to pass away. Now, if she hadn't accessed any of the benefits under this policy previously, that's a $500,000 policy. It's a $500,000 the husband now has. He can use the money for whatever he wants to. And if that goes to pay for his LTC expenses, so be it. We've now provided the dollars for him to do that. And we've given them 3 different ways that they can accomplish the same thing. So moving on to our second item here, I'm going to talk a little bit here about joint coverage. Now, this is something that is fairly common on traditional long-term care policies. And basically, you have a husband and wife, and they have a shared pool of money that they can both access for long-term care expenses. They're both sharing that same pool. Now, unfortunately, this is not available with most life insurance-based plans. Now, there's one exception to that, and that's State Life with their asset care portfolio. One of the options is to have a survivorship plan, and in that case, both spouses have access to that same pool of dollars to use for long-term care expenses. And the death benefit still pays out if there's anything remaining at the death of the second insured. So how does it work in an example? I'm going to use a couple here. We're going to call them Howard and Marion. They were on TV back in the 70s and 80s, if you remember that show. But let's assume in this case that Howard and Marion each purchased their own policy through State Life, single person policies. A death benefit was set at $250,000 in this case, and that gave them a $5,000 a month LTC benefit. And incidentally, this benefit goes for 50 months, or essentially 4 years and a little bit more. They have 4 years of coverage. The premiums are at the bottom. It totals up to just over $17 grand a year. So 4 years of coverage. Keep that in mind. Here's a little what-if scenario. What if Howard develops Alzheimer's at age 75? And he requires care not just for the 4 years his policy covers, but for the next 8 years. And Marion's still healthy. Howard passes away after 8 years of needing care, half of which was actually covered by his policy. Marion passes away later on. She never needs long-term care at all. She passes quietly in her sleep, just like all of us think we're going to go. And her death benefit still pays out of her policy. But there was 4 years of coverage that, maybe could have been used, or wouldn't have been nice if we could have used that for Howard's care when he needed care. Well, you know what? That's actually an option. All we have to do is give Howard and Marion a joint policy. Instead of each having $250,000, let's give them $500,000 that they can both share. Now we've got a $10,000 a month LTC benefit. So if Howard requires 8 years of care at $5,000 a month, guess what? It's covered. He can use up that entire policy if he wants to. In this case, Mary never needed to tap into it, so we've got everything covered. So we've now given our clients a lot more flexibility than what they would have had otherwise. And we've saved them some money, too. I mean, in red there, if you can see that, we've saved them $3,200 a year. I mean, what client wouldn't want to save $3,000 a year and receive more flexibility in return for that? So when you're dealing with a husband and wife, it's well worth a look at one of these joint shared care plans that State Life, to my knowledge, is the only company out there that offers this. All right, the third item I want to tackle this morning is a way to get creative with inflation protection. Now, this is another feature that we find on traditional long-term care policies. It's very common. In fact, at certain ages, I think it has to be offered to a client, and that's typically a 3% or a 5% inflation rider. Simple or compound inflation, you usually have the option to do one or the other, and it will increase that monthly benefit that the client receives. Now, this is actually available on some of the hybrid policies right now, but it's typically just on the single pay products. State Life's Asset Care, the Money Guard from Lincoln Financial, Genworth TLC, they all have that as an option. But it isn't offered on most of the multi-pay universal life plans out there. Now, why is that even a problem? Well, the latest statistics I saw from LIMRA say that only 25% of the hybrid or linked benefit plans sold were of the single premium variety. 75% were based on these multi-pay plans. The client's paying an annual premium forever and ever. They're paying a monthly premium. 75% of the folks buying these products don't even have the option to put inflation protection on their policy, so they have to buy more coverage up front. What if you don't want to do that? What if you'd like to have an amount that covers the cost of care today and that increases down the road and every year somewhat matches the cost of care? Well, again, you've got to get creative, but there is a way you can do that with some of these products. One, we're going to go back to AIG and their chronic illness rider. Now, if we give the client the full per diem option, right now that's $330 a day. I mentioned earlier that number has typically been going up every year by 4% per year. Now, that gives us essentially a 4% inflation protection option. The only downside with this particular product is the total pool of money doesn't change, but the amount they can access out of that pool every month will increase every year. And I've got an example coming up here that will show you at 4% per year projected what that would be. Again, that's not guaranteed, but for the past several years, that amount has been increasing at 4% per year. So that's one way you can give your client sort of a look-alike inflation protection rider. Now, we also have some other carriers that offer an increasing death benefit option with their chronic illness or long-term care riders. Now, the one thing these products don't offer is a no-lapse guarantee provision. Actually, it is available with Prudential with their product. But all of these are index UL products, so the cash value will grow based upon the formula that they use, which is usually based upon the movement of the S&P 500. And whatever your monthly option is, let's say it's 2%. If it's 2% of a pool of $100,000 this year, that's great. You get $2,000. But what if that pool of money grows as your cash value grows? Well, guess what? 2% of a larger number is going to be a larger number. And I've got an example coming up here that will demonstrate that. But going back to the first one here, using the AIG rider, here's what we would be seeing. Right now, our monthly benefit is at $9,900. If we project that up at 4% per year, we can see in 11 years, in 2025, now we're up to $15,000 per year. If we look all the way out to year 2040, we've just about tripled our monthly benefit amount that's available. So that's giving our client sort of some built-in inflation protection without putting on an additional rider, just by selecting that per diem monthly benefit amount. Now, the other products with the increasing death benefit option, I chose to use a Axa and their IUL in this example here. We happen to have a client who is basically starting out at age 50. He's paying almost $6,000 a year for his policy, and it started out as a $250,000 death benefit. That's also a $250,000 pool of money for LTC. I chose 2% as our LTC monthly benefit amount, so that works out to be $5,000 a month is available from the get-go as an LTC benefit. But what happens as our cash value continues to grow in this policy? 1 year 10, our pool of money has now grown to $307,000. That's projected and gives us about $6,100 a month for LTC. If we look out to year 20, now our pool is over $400,000. That's equal to about $8,600 a month for LTC. Now that continues to grow and grow, and in year 30, we've got over $650,000. Client makes it to year 40, that would be age 90. Person's going to need care. That's probably about the time they're going to need it if they haven't passed away already. Now our total pool available for LTC is $1 million, just over $1 million. We started out with $250,000. Over 40 years, it's grown to $1 million. We started out with $5,000 a month. Now we're up to roughly $20,000 a month that would be available for LTC. So we do have a way to essentially put on some sort of inflation protection or build that in to some of the products. We just have to use the right sort of product to accomplish that. I'm going to move on to our fourth item here, and that's funding one of these hybrid products with qualified funds. Why would we want to do this? Well, what if we have a client who really wants some sort of extended care protection? But one, they don't have the cash flow to pay this ongoing premium every month or every year. And two, they don't have a lump sum sitting in the bank in a CD or a money market earning no interest. They don't have that money laying around to use for one of those single pay products. So what do? We just leave them uninsured? Well, a lot of people have got most of their net worth tied up in their 401k plans right now, and they think the only way they can access that is in retirement. It's primarily meant to be their retirement income, so why would they think anything else? Well, we're going to go back to State Life right now, and they have devised a system for us to tap into that 401k or qualified plan money to use to purchase one of these policies here, and they can do it while minimizing taxation. So here's how it works. I'm going to use pictures because I think, for me at least, this makes it very clear how this works. So our client, first of all, they have to be 59 and a half or older to make this work. But our client has money right now in their 401k or their IRA. And what happens with this product is they do a direct transfer, not of all the money, but just whatever amount is needed to fund the proper amount of LTC protection. They're going to do a direct transfer into State Life's Asset Care Annuity. At this point in time, we don't have a taxable event. We've just moved money from one pocket to another. What State Life is going to do internally is take money out of that annuity every year over 20 years to pay for the Asset Care product that is the life insurance solution with an LTC benefit. So client still has to pay taxes on that money, but the taxation is spread out over a 20-year time period. You could also do this with different carriers' products. I mean, you could get them a SPIA or withdraw from another annuity over 20 years. Then the client has to do double the paperwork. They're going to receive a check every year, then have to write a check, receive a check, write a check, receive a check, write a check. You can imagine at some point along the way, they're just going to spend that check they received, or they're going to forget to write the check for the other policy, then the protection is going to go away. So this makes the whole process seamless and very convenient for the client by doing it this way with State Life. Now, here's an example to show you how this really works. We have our male age 60 again, and in this case, we're going to move $200,000 from that 401k. Maybe at that point in time, he's got $1 million or $2 million in there, so $200,000 isn't going to be a big deal. And what happens within this particular illustration, we have $13,000 a year removed from the annuity to pay the 20-pay whole life insurance premium. Clients can receive a 1099 for that $13,000 every year for the next 20 years. It's a lot better than receiving a 1099 for $200,000 in just one particular year. And again, this client is a person who didn't have another source of funds that we could use for this sort of a product. So here's what the illustration actually looks like. I pulled these numbers from. You can see there in year one, we've got the $200,000 going in and the $13,000 a year going into the life policy. We have our cash accumulation fund listed. We also have our total pool of dollars available for long-term care. So we've gained a lot of leverage on that money right there. And again, we've tapped into those qualified funds that the client otherwise didn't know he or she had available. All right, we're going to get to the last item here, the last creative solution with linked benefit products. And I like to call this extreme leverage. Now, I got this idea from the folks at Lincoln Financial, and it's going to utilize their MoneyGuard hybrid product. And it's also going to utilize a unique annuity product of theirs. And I encourage you, if you need more details on the annuity, to talk to your annuity marketer here at Financial Brokerage. They can help you with that end of things. But this is a real innovative way to fund for these extended care expenses. And we're going to combine both a rider from that annuity with the 10-pay MoneyGuard product, so your clients can receive maximum leverage on their dollars. Now, here's the typical way that we see these single premium linked benefit plans working. Client has a single premium. With that single premium, they purchase both a death benefit and a long-term care benefit. So they're receiving some leverage on those dollars. But what if we could give them even more leverage on those dollars? So use that single premium to give them even more benefit than what they're getting right here. Well, it's possible, and Lincoln Financial has come up with a way to do that. So instead of our previous scenario, we have a few more boxes here, so it gets a little more complicated. But I'm going to show you several different ways that this can be illustrated. So now our single premium isn't going to buy, directly purchase that policy. The single premium is going to buy an annuity with an income rider. And this income rider for the first 10 years is going to go towards the 10-pay MoneyGuard product. So now we have our death benefit and long-term care benefit combined. It's just purchased on a 10-pay basis, still with that single premium that has now been turned into an income stream. So that income stream for the first 10 years goes to pay for the MoneyGuard product. After year 10, the client's still receiving the income. They can receive this income for the remainder of their life, and the income happens to double if they require care in an actual nursing home. It doesn't double for home health care or assisted living, but just for a nursing home. If they're receiving home health care or assisted living, they're still receiving the regular income that they were receiving previously. So we've got some more leverage on those dollars. Here's how this looks inside of an illustration that I ran. In this case, we had $200,000 going to fund this, and that gave us $9,300 a year. Over 10 years, it went to fund the MoneyGuard product that you see right here, and over on the right, we have our LTC benefit amounts. I'm going to break that down a little bit more for you as well. In fact, here's the example I was giving. If you learn better by reading how this works, the slide is great for you. That $200,000 is going to fund the Axa Point 10, generate $9,300 of income for life. That begins immediately. So for those first 10 years, it funds the MoneyGuard product, and that gives our client in this situation $320,000 of tax-free long-term care benefits. And that increases as well. We put on the 3% inflation rider I was speaking about earlier on this particular product. After 10 years, that product is paid up. So now our $9,300 goes directly to us. It isn't going to pay for this linked benefit plan anymore. Now, a client can do a couple things with it, and in this example, I'm going to assume that they're just putting that money in the bank. They're going to use that as extra money to help pay for long-term care expenses down the road. Again, if they do require care in a nursing home itself, that income amount is going to double to just over 20 grand in this case. Now, what does that look like for our 60-year-old 20 years down the road? Here's what it looks like at age 80. We've had $187,000 of income generated by this annuity. Now, the first 93 grand went to fund the money guard. The remainder, we put that in our pocket, and if we didn't earn any interest at all, we have $93,000. At that point in time, our LTC benefit inside the money guard has grown to over $500,000. Plus, if we require care in the nursing home, we're looking at an extra 20 grand a year, and we still have a residual death benefit available. Now, how does this compare with our initial example? I'll see if I can go back to it here. Here's our traditional example. We have a single premium, and it buys a death benefit and a long-term care benefit. What if we did that instead? We just put our 200 grand in there. What would we be left with? Well, here's our example. If we did that, you're going to see that column over on the left, just a traditional single pay kind of policy. In year one, we have 10 grand available for LTC, and with our 10 pay product, we're not doing so well right in year one. We have 4 grand available. We wouldn't have been better off with that single pay product, unless, of course, we needed care in an actual nursing home. Now we have 20 grand a year available. So early on, you don't realize that leverage. The leverage comes later. So in year 11, we're actually doing a little better now. You look at the single pay product, almost 14 grand available. On our 10 pay product, we have almost 15 grand available. Now maybe an extra grand a month isn't enough to do all the extra paperwork. But look what happens over there on the far right. If our client needs care in an actual nursing home, that gets bumped up about another 10 grand for the client there. So that's where our leverage comes into play. Leverage gets even greater in year 20 and year 30. With the traditional way of handling this, in year 20 we have 18 grand almost available. With our 10 pay product, we have 16 grand. Now you might be saying, well, that's not as much as if we had done just a single pay product. But look what happens if we took all that money we were receiving every year for the last 10 years. It didn't need to go into the policy. We put it in the bank, put it under the mattress, let's say. We had no interest. Now we have an extra 93 grand we can tap into. How long is that going to last us? Especially if all we need to equal the traditional policy is an extra $2,000. If we need care in a nursing home, it's an even larger number once again. And the numbers get even bigger as we look at the 30-year scenario and then even at the 40-year scenario down the road. Traditionally, we'd have about 32 grand. Now, with this extreme leverage in play, we've got 22 grand plus a pool of money, almost an extra $300,000. If we haven't received any interest at all, we can pull from that for a long time, and we're going to do better than our 32 grand that was available in the other scenario. Plus, if we're in an actual nursing home, now we have even more money available. So that's where the extreme leverage comes into play. It really shines if your client gets to the point where they need nursing home care, and also after 20, 30 years having this policy, they have an additional pool of money there. So this isn't going to work in every situation. This isn't a good fit for every client out there. They need to understand how this works. It's going to take maybe a little more sophisticated client. But if you have, if you work with investments or work with retirement planning, you're going to have a little more sophisticated client, and they're used to finding ways to receive leverage on their dollars. You might even present something like this, and they go for the traditional plan. That's fine. You've shown them an additional option that I almost guarantee you nobody else is talking about at this point in time. So we're going to wrap up the webinar shortly here, but just to recap the 5 advanced concepts we discussed this morning. Went over a real creative way to help with an uninsurable spouse. Talked about a way to get joint coverage on a linked benefit plan. Went over some interesting ways to basically give our clients inflation protection where it otherwise doesn't exist on multi-pay policies. Found a way to tap into qualified funds, which is very convenient if our clients don't have any other resources to utilize, and also went over a way to obtain what I would call extreme leverage on those dollars. And I'm going to get to any questions here in a minute, but your mission after hearing all these ideas is to realize that you can protect your clients' assets from the greatest threat they face in retirement. You can do that in a lot of different ways, but you do have the option to present some real creative advanced solutions with these linked benefit products, so your clients don't have to worry about the high cost of extended care or wasting their premium dollars down the road. And we'll see what questions we have here. As I'm pulling up our questions, though, I do want to thank everybody for joining us this morning. And if we don't get to all of your questions, I'm available here for you. I'll put my contact information up on the screen. And if you know of some other producers out there who you think this information would be of value to them and their practice, by all means, don't keep us a secret. We're never too busy to see who else we can help.